This is FRM Part II, Book 4, Liquidity and Treasury Risk Measurement and Management, and the chapter on Intraday Liquidity Risk Management. This chapter is taken from a textbook called Liquidity Risk Management, a Practitioner's Perspective, which is a little bit different from the previous few chapters that we've read, which were written by professors. So they had more of an academic viewpoint to them. I really enjoyed reading the first couple of paragraphs of this chapter because it provides an important history lesson going back to around 1980. Those of you who are old enough might remember that during the 1970s, at least in the United States, but other parts of the world, we had tons of inflation. So the Fed chairman, this guy named Paul Volcker, over a 2-year period, he essentially doubled the federal funds rate. I think it was from somewhere around 11% to about 20% in 1981. And so I don't know if you're like me, but boy, it's hard for me to even imagine an economic scenario with an 11% Fed funds rate, let alone a 20% Fed's fund rate. But the reason that this history lesson is important is because it kind of marked the beginning of an awareness of the importance of intraday cash management. Of course, it didn't mark the beginning of it, but this goes way, way back. But it marked the critical importance of intraday cash and liquidity management. Of course, back in 1980, I bet some of you remember that the Fed was not allowed to pay interest on any of its bank deposits, and correspondent banks were limited in the amount of interest that it could pay on some kinds of demand deposit accounts. Of course, those rules have been long gone. But as you look at the 3 learning objectives in this chapter, I want you to focus on this key word. Look in objective 1, 2, and 3: intraday, intraday, and intraday. And so this makes perfect sense that good questions from this chapter are going to relate to intraday liquidity, intraday risk, and then intraday cash flows. As we do in many of these slide decks, let's go ahead and start with some definitions. So let me go ahead and read these to you. Intraday liquidity, cash funding that can be accessed at any point during a given day's operations. And of course, the idea is that this is cash funding so that we can continue to process transactions. So interbank fund market, money markets, and then credit lines provided by central banks. And some of these other FMUs, these financial market utilities, these are interesting kind of organizations. It's better just to give you some examples of these. Chicago Mercantile Exchange, the Fixed Income Clearing Corporation, Options Clearing Corporation. So these are kind of financial institutions, financial entities. Of course, the correct term is to call them a utility that have clients borrowing and lending, and that those clients have settlements, and so there needs to be a whole procedure. So the FMUs kind of have great influence in this intraday liquidity market. Now, of course, intraday liquidity risk is the risk that one of these organizations is unable to cover a payment. When I teach derivatives to both my graduates and undergraduate students, we talk about marking to market and daily settlement, and then final settlement. And I tell them that in many cases, this settlement risk is not too great, mainly because spot prices and derivative prices, are somewhere near each other. But when you get into the extremes, when the exercise price of an option is way different and the option is way in the money, then you have this huge issue of settlement risk. And I always give them the example, and I've done this in previous recordings as well, is that if I'm the other side of the transaction and the derivative is going to mature or expire here in the next few minutes, you have to come and knock on my door. Well, I'm not going to answer my door. And in fact, I'm going to run around the block so you can't catch me. All right, let's go ahead and focus on that first learning objective. So uses of intraday liquidity. And of course, I'm guessing that you guys in your daily life, not to mention your professional lives, deal with these outgoing wire transfers. So this is typically the most significant use of intraday liquidity, and the payment kind of lasts the entire business day. And the interesting thing about this is that it's reasonably predictable. And so there's this concept of throttling that goes on. And so let's just do a quick example. Let's suppose that you and your husband and wife, you both work, and let's suppose, just for argument's sake, that you have 5 or 6 children and they all work, and that you guys get paid through direct deposit into your bank account. And for some crazy reason, you guys all get paid on the same day. And then for another crazy reason, all of your monthly bills have to go out on that same day. All right, so this is how a bank operates. So think about what you have to worry about. You have to worry about when are those deposits coming into your account. And let's go ahead and make it even in a crazier example. Suppose you have, one child who works in Europe, you have another child who works in Africa, another child works at the North Pole, another child works in Canada, and so somehow all these come into one account, so they're going to come in at different times. All right. And then you have the electric bill and the cable bill and the mortgage bill. You have all these things going out. And so if for some reason at one point of the day you have more going out than you have in, well, then you're going to default on that particular payment. And so this concept of throttling is that when you get lots of cash, when you have these inflows, let's go ahead and ramp up the outflows so that we can make sure that we pay those. So notice that second block point. Closely monitor incoming credits to ensure that there is enough cash in the account so that we can meet all those liabilities. So, in my little simple family example, this is what financial institutions face, not just every day, but every part of every day, like a morning and a midday and a late in the day. Now, having said that, look at the bottom orange point. So most of these payment, clearing, and settlement systems have a single settlement per day. So all this done most typically in late afternoon, not least of which is because of reserve requirements and trying to figure out how much cash is available by the end of the day. And notice the second block point may serve as either a source or a use of funds, depending on the net positions during the course of that trading day. Now, how about this concept of nostro and vostro accounts? So this is really just correspondent banking. Look at the example that we have illustrated there. We have Bank X in India. Doesn't India, I'm wondering if there are some of you guys out there from India, doesn't India have a bank called Yes Bank? I thought that's kind of cool. Yes, Yes Bank. And suppose that this Yes Bank or this bank in India has, clients throughout India, but they also have some kind of either personal or business relationship with either clients or businesses or family or friends in the United States. And so, this bank in India, they probably don't want to get on a plane or a boat and come to the United States just to open up a bank, just to have a bank there for those minimal accounts. And, a lot of times they are minimal. So they'll just pick up the phone and call a U.S. bank and say, hey, can you open an account for us on behalf of this particular business or this particular client? That's called a nostro account. And so, of course, these financial institutions, and these are most typically large financial institutions, they have these international transactions flowing in and out between and among different currencies. Because look, the example that we give you here, just India and the USA, I mean, we could have a green and a yellow and a pink and all these other kind of boxes for all these different countries. So you have a myriad of currencies, and you have a myriad of clients, and you have a myriad of types of accounts. How about one part of that learning objective here? Let's talk a little bit about collateral pledging and collateral pledging and asset purchasing. Now, we've spent a pretty good amount talking about collateral, and so banking activities typically involve some type of collateral. So look at the examples that are given in those circle points. Over-the-counter capital markets trading, and then deposits, all kinds of different deposits. But, it could be public funds, but it could be other stuff as well. And so the idea here is that you have this transaction, and then over time, right, spot prices go up and down, and interest rates go up and down, and so that derivative either becomes more valuable or less valuable. And when it becomes less valuable, then you'll probably get something, like a margin call, in which you'll have to go ahead and either say, okay, here's $1 million in cash, but you probably don't want to do that. You might want to just come and say, what do I use? Oops, sorry about that. What do I use in many of my examples? You guys remember me using this example of my HP 12C calculator. I will say this, note that it's always handy here whenever I want to use it, because I use that calculator all the time. Notice the bottom circle point before we move on. These collateral positions are adjusted daily. So not only as this intraday liquidity risk management requires us to be aware of what's going on in spot markets and in derivative markets and in the credit markets, but we also have to be aware of what's happening to the value of our collateral. Now, what we can also do with this intraday liquidity is we can buy securities, we can make loans, and we can buy some fixed assets as well. Now, the chapter has an interesting segue between, what we just discussed here and a table. And the table in these next couple of slides here is taken pretty much from the chapter. The authors say, fortunately, banks have lots of sources of intraday liquidity. And so that's a practitioner's way of writing, and probably not an academic's way of writing. And so what I want you to do here, I'm going to go through these. Look down that left-hand column. So sources of intraday liquidity, cash balances, of course, right? Incoming cash flows, intraday borrowing credit, and then we can sell some assets, and then we can borrow. All right. So I want you to think of these as 5. So sources of intraday liquidity. So there are 5 of those. So this sounds like, probably at least 5 good exam questions in which there is some kind of a question stem describing a scenario, and then one of the choices are, one of those 5. And so the description there, those are pretty obvious notions. I'm guessing that you can understand that. But then I think the next best question is skipping over to the far right, ability to forecast. So how can we forecast things like cash balances and incoming flows? And so a great exam question would be, is it more difficult or is it less difficult to forecast client activity and bank activity based on things like cash balances and incoming flows? And we have these summarized here for you. All right, how about the next learning objective? Sound governance structure. All right, this sounds like an awful lot like something that we probably have discussed in previous recordings. Remember, we talk about the importance of the board of directors, and in this case, we talk about the importance of highly skilled individual financial institution leaders. And so in this particular case, this is going to be the chief risk officer. So that's a sound governance structure should include, a whole series of things that we've probably mentioned before. Active risk management. Look at that first block point here. Should not be viewed as a passive. Let's forget about the rest of those words there. Should not be viewed as passive, right? We're not just going to sit around and say, okay, let's scratch our heads and hope nothing bad happens today. So read those words after passive. Ever-present, immitigable, unmanageable risk. So we don't want to think about this as, okay, that's something out there, and it's going to be this meteor that drops from, I don't know, where do meteors come from? Do they come from our galaxy? Do they come from other galaxies? So we have this meteor that crashes down in our front yard. Well, of course, we don't want to do this. So look at the second block point. Take a more proactive approach toward intraday risk management. Let Let me go back to our discussion on risk culture. So clearly this has to come from the board, and this has to come from the executive leadership team. Proactive means that the chief risk officer then tells or informs all his or her, business unit managers, hey, look, we need to pay attention to this. I want you to be active. I want to know what's going on. Boy, do I want to say every second of every day? Probably not. Every minute of every day? I don't know. That sounds a little bit much, but clearly on an hourly basis, and then when there's more volume or more uncertainty. And look at that circle point there that we've written. For example, settlement and systemic risks should be identified and explicitly incorporated into the bank's risk appetite framework. There's that one word. What do I tell you? Identify risk, quantify risk, and manage risk. All right, how about integration with risk governance? This is exactly what I'm talking about here. The 3 lines of defense: Treasury, corporate risk management, and people who kind of look over our shoulder and say, make sure you're doing this the right way. Remember, I said this in a previous video about this internal audit. You know that sooner or later someone's going to come along and evaluate our structure and our governance and our decision making. And so let's do this with integrity, as I try to teach my children to make decisions as if mom and dad are staring right over your shoulder. And then look at the final circle point that we've written down there, taking intraday liquidity more seriously. Okay, now that doesn't mean simply saying, okay, we're going to take this seriously, but actively identifying and designated individuals and groups of individuals with certain responsibilities. For example, it's not sufficient to tell somebody to say, okay, go stand out in our parking lot and look up. And if you see a meteor falling, get the megaphone out and yell to us. Risk assessment. So this is what I say, identify, quantify. So this is the quantify part. Measure and assess intraday liquidity risk. So particularly settlement risk. So let me swing back to my conversation that I have with my students regularly about settlement risk. This is the risk that we're not going to settle, and the risk that we're not going to settle is because that other party either A, doesn't have enough capital to settle the contract, or is pretty much unwilling to do it. My example of me running and hiding throughout the neighborhood. And so, of course, internal controls. This is a beautiful thing, a beautiful process that will not just encourage, but maybe even solidify, let me go back here, this bank's risk appetite framework. And then measurement and monitoring, we can do this probably 1 or 2 days. So the amount of intraday credit the institution is extending to clients and the amount of intraday credit that the institution uses. And so this is really just a matter of, okay, how much is going out and how much is coming in? Are we borrowers or lenders? Now, how about that learning objective about tracking intraday flows? And there are a variety of these here in the next couple of slides, but I want to go back and give you one of my great sports analogies. Those of you who are golf fans will know that the easiest way, and those of you who are even not golf fans will know the easiest way to determine the quality of the performance of a golfer is just by looking at his or her scores. Clearly a 65 is better than a 75. But data analytics has taken over all industries, including the golf industry. And so now there are statistics like, strokes gained on the green, strokes gained driving, sand saved, fairway hit accuracy, greens and regulations, like all these different statistics to kind of measure the performance of the golfer. But it's kind of like an intra-core measure, so some golfers are better around the green, some bettors are better off the tee, et cetera, et cetera. So these methods for tracking intraday flows are kind of different ways of looking at overall performance, right? So we can have an overall great ability and willingness to track intraday flows, but there might be some weaknesses inside inside of that whole institution. And so that's what we're doing here. So total payments, that analogy is for, number of strokes that a golfer takes to get around a golf course. These need to be stored in a data warehouse, including things like payment amount, time received and stamped, time for processing each step. And so we can get into things like volumes. We can do net settlement positions. And of course, those of you who love technology and love to be technical about this, boy, there's no reason for you not to put together some kind of a risk analysis based on things like standard deviation and maybe covariance, maybe beta. The textbook refers to correlation analysis. Let me go ahead and pause. Boy, you never want to miss this question on any kind of exam. Remember, correlation doesn't mean causation. All right, so let's get more granular here. So other cash transactions. So monitor intraday and end of day settlement positions, and then maximize the volume of transaction level detail. And then we're going to store it for further analysis. So remember what I said just a few moments ago. Do we want to do this every second? Do we want to do this every minute? Do we want to do this every hour? But clearly there's a time period under which we can figure out what is the most important time period during the course of the day. And then of course the end of the day settlement is extremely important. I heard several stories about traders on the futures exchanges, and some of these individuals who have seats in their own name on exchange, they never let a position open for the next trading day. They close out all of their positions. And so that always struck me as, okay, these really smart men and women who are trading for themselves and for others, they don't want to have to go to sleep at night worrying about what happens overnight. So for financial institutions, that end of the day settlement position is equally important. Now, of course, this leads us right into settlement positions. So you got to keep data on its settlement positions with all of those utility organizations so that you have completeness of data. And then we'll go ahead and monitor those as well. And we'll keep track of time. That makes perfect sense. Total intraday credit lines to clients and counterparties. So remember, as a financial institution, I could go in as a client. I'm Jim. I could go in and say, hey, I want this credit line, for $100,000. I might use $200 of it today at 2 o'clock, but then tomorrow at 4 o'clock, I may use $60,000 of it. So we need to keep track of all that stuff. Look at that second block point. This is important. Here we go. We have average and we have ranges, right? So the average, that tells us something. It doesn't tell us everything. And we should probably throw standard deviation in there as well. But we want to have, peak uses, and are there times when there's absolutely no usage? And so this can be reduced to some kind of calculus in which we can perform some kind of an objective function and then take first derivatives and second derivatives and, try to figure out, what's the best way to manage these intraday credit lines rather than just, like in the old days, they just threw it out there and said, okay, whenever you guys need the money, you can have it. And then total intraday credit lines available and their uses. So, you think about, I always think about this as like the population. So you have the population out here. So these are the credit lines available. And then the sample, how much of those are being used. Boy, there's one of my favorite words up there. We want to quantify and monitoring. Monitoring is a little bit part of management. So daily maximum intraday liquidity uses, and then the intraday credit relative to the tier 1 capital. And so these two are extremely important in terms of having different types of balances. So look at that second block point. That daily maximum, it's the ratio of the day's most significant net negative balance relative to the size of this credit line, whether it's committed or uncommitted. And so look, peaks and averages. So there's a range, and we can figure out exactly, what's happening. Is that peak, is that stable? Is that average stable? Are they trending one way or another? I always tell my students that when you evaluate some data series and you're using some kind of a metric like an average or a peak here, it's one thing to look at that number and say, okay, this has meaning to me today, but what about the trend over time? And then finally, how about client intraday credit usage? Comparing a client's peak daily intraday overdraft to the established credit line. So being aware that some clients are going to say, hey, I need more than what you've offered me, or at least I need more than what you've offered me today, or hey, how can I get an extension, or can I get an increase, et cetera, et cetera. And then the payment throughputs is a measure that tracks the percentage of this outgoing payment activity relative to the time of day. So I mentioned this before. Is 10 o'clock interesting? Is 1 o'clock interesting? Is 3 o'clock interesting? And so it's important to know what is interesting about our intraday liquidity from a time standpoint, and then how it relates to these utilities. I mean, especially if we're doing if we have this gigantic derivatives unit and we're constantly on the floor of the Chicago Mercantile Exchange, we know that it as a utility has its own issues of cash flows in and out, and how do we fit into their cash flows as well as our cash flows? And that takes us through these three learning objectives. And so let me just remind you here, intraday, intraday, and intraday. And if I had to pick one of those three, I'm not sure which one of those three I would pick, but if I were writing questions, I could probably write the most interesting questions in that second one.